Before we begin, it's crucial to state that the information provided in this video is for educational and informational purposes only and does not constitute financial, legal, or insurance advice. The world of insurance is complex and specific to your individual circumstances. We are not licensed financial advisors or insurance agents. This presentation is designed to empower you with knowledge so you can make more informed decisions and have more productive conversations with a qualified, licensed professional. Always consult with an expert before making any changes to your policy. A sudden deafening screech of tires, the sickening unforgettable crunch of metal and glass. Your heart is hammering against your ribs, and for a split second, the world goes silent before the chaos floods back in. After the initial shock, after you've checked to make sure everyone is okay, what's the very next thought that rips through your mind? For millions of Americans, it's a cold, sinking feeling of dread, followed by a single terrifying question. Is my insurance going to cover this? Did I choose the right company? Did I just make $1,000, a $10,000, or even a life-altering mistake by picking the wrong provider months or even years ago? Here's a statistic that should stop you in your tracks. The average American driver will file a claim for a collision roughly once every 18 years. That means over a typical lifetime of driving, you're statistically guaranteed to have 3, maybe 4 accidents. It's not a matter of if, but when. And when that moment arrives, the company you chose, perhaps based on a funny commercial or a low introductory price, will instantly become the most important financial partner in your life. The auto insurance you have could be the single most impactful financial decision you make this year. Yet most of us spend more time scrolling through streaming services to pick a movie than we do understanding the giants that absolutely dominate this industry. And frankly, that's exactly what they're counting on. But that changes today. This isn't just another boring, surface-level list of companies. This is your definitive guide to the 5 titans of American auto insurance. We're not just going to tell you who they are. We are going to pull back the curtain and show you how they operate, the psychological tricks behind their marketing, who they're really designed for, and the hidden clauses and secrets in their policies that could save you a fortune or cost you everything. By the end of this presentation, you will understand the immense power these companies wield. You'll know their strengths, their weaknesses, and their market share, which is a crucial metric that tells you just how many of your friends, family, and neighbors are already their customers. You'll be equipped to look at your own policy not with confusion, but with crystal clear confidence. You'll know the right questions to ask, the red flags to watch for, and you will be transformed from a passive customer into a savvy, empowered consumer. We are going to demystify the jargon, slice through the marketing slogans, and give you the raw, unfiltered truth about who holds the keys to your financial security every time you get behind the wheel. So what exactly is market share? And why on earth should you care? Imagine the entire United States auto insurance industry is one giant pizza. Market share is simply how big of a slice each company has claimed for itself. A bigger slice means more customers, more premium dollars flowing in, more data to analyze, and ultimately more power and influence. A massive market share can mean a company has the scale to offer incredibly competitive rates in certain areas, but it can also mean that to them, you risk becoming just another policy number in a colossal impersonal system. The top 5 companies we're about to dissect control over 60% of that entire pizza. Let that sink in. More than half of every single insured driver in America is a customer of one of these 5 behemoths. Your choice matters profoundly because you're not just buying a policy. You're buying into a massive financial ecosystem with its own rules, its own priorities, and its own definition of customer loyalty. We're going to count down from number 5, working our way up to the undisputed king of the road. Each of these companies has a fascinating origin story, a unique strategy for winning your business, and a very specific type of driver they secretly love to insure above all others. So buckle up. Let's get started. Coming in at number 5 on our list is a company that has masterfully used branding and technology to become an inescapable force in the industry. This is a household name you've definitely seen on TV, known for its quirky, friendly, and relentlessly upbeat marketing. But behind that approachable facade is a calculated, data-driven machine that has strategically carved out nearly 14% of the entire U.S. market. Let's talk about Progressive. Founded back in 1937, Progressive's entire business model was built on a revolutionary idea at the time: insuring drivers that other companies considered too risky. While traditional insurers were only interested in the safe drivers, Progressive's founders saw a massive, untapped market and decided to cater to it. This DNA of embracing risk and using data to price it accurately is still at the very core of their operations today. They weren't afraid to be different, and that maverick spirit is what propelled them into the top tier. You can't talk about Progressive without talking about Flo. In 2008, they introduced a character that would change the face of insurance advertising forever. Flo, the super perky name-tag-wearing employee, was a stroke of marketing genius. She demystified insurance, made it feel accessible, friendly, and even a little bit fun. She wasn't a celebrity. She was an every woman. This campaign transformed Progressive from just another insurance company into a pop culture icon, a brand that felt familiar and trustworthy. But their real secret weapon isn't their marketing. It's their relentless focus on technology and customization. Progressive was one of the first major insurers to sell policies directly to consumers online, cutting out the middleman and passing some of those savings on. They pioneered tools like the Name Your Price tool, which cleverly flips the script. Instead of them telling you the price, you tell them your budget, and they show you what coverage options you can get for that amount. It's a brilliant psychological move that gives the customer a feeling of control, even if it means they might be selecting less coverage just to hit a specific price point. Then came their biggest and most controversial innovation, Snapshot. This is their telematics program, where you either plug a small device into your car or use a mobile app to track your driving habits. It monitors things like how often you drive, the time of day, and, most importantly, how often you brake hard. The promise is simple. Prove you're a safe driver, and you'll get a significant discount. For many drivers, this is a fantastic deal. If you have a short, safe commute and rarely drive at night, Snapshot could save you hundreds of dollars a year. It rewards good behavior directly. So, who is Progressive really for? First, the tech-savvy, hands-on consumer. If you like managing your accounts online, using mobile apps, and having direct control over your policy, Progressive's digital experience is one of the best in the business. Second, the budget-conscious shopper. Their tools are designed to help you find the absolute lowest price, and their rates are often highly competitive, especially if you're a safe driver who can take advantage of Snapshot. And third, because of their company DNA, they are often a great option for drivers who may have a blemish or two on their record. Where other companies might turn you away, Progressive is often willing to price that risk and offer you a policy. But here's the catch. The very tool that offers savings, Snapshot, can also work against you. If the data shows you're a riskier driver than they thought, maybe you work a late shift or have to brake hard often in city traffic, your rates could actually go up at renewal time. Furthermore, while their online tools are top-notch, their human customer service can be a mixed bag. The experience can vary wildly depending on whether you're dealing with a direct representative or an independent agent. For some, the service is seamless. For others, it can feel frustrating and impersonal, especially during the stress of filing a claim. Progressive is a powerhouse built for the modern digital-first driver, offering incredible tools and competitive rates, but it demands that you pay close attention to the details and understand exactly what you're signing up for. But what if the entire business model wasn't built on complex algorithms and telematics, but on a simple, almost laughably obvious observation about people? What if you could build an empire by targeting the safest drivers from the very beginning? In 1936, a man named Leo Goodwin, working for another insurance company in Texas, had this exact epiphany. He looked around and realized that certain groups of people were simply less risky to insure. They had stable jobs, they were responsible, and they got into fewer accidents. His prime example? Government employees. And so, the Government Employees Insurance Company was born. You know it today as Geico. Geico's entire foundation is a masterclass in risk management. Instead of casting a wide net and using complex math to sort out the good drivers from the bad, Goodwin's idea was to fish in a pond stocked only with the best fish. By marketing directly to federal employees and certain categories of military officers, Geico could cherry-pick a low-risk customer base and, in turn, offer them significantly lower premiums than anyone else. It was a direct-to-consumer model decades before the internet made it cool. No agents, no commissions, just a simple value proposition. You're a safe driver, so you should pay less. This brilliant, focused strategy caught the eye of a young investor in the 1950s, a man who would later become the most famous investor in the world, Warren Buffett. Buffett saw Geico not just as an insurance company, but as a money-making machine unlike any other. He understood the secret sauce of the insurance industry, a concept called the float. See, when you and millions of others pay your premiums every month, Geico doesn't just stick that money in a checking account. It collects this massive pile of cash, the float, and invests it. They get to use your money to make more money for themselves before they ever have to pay it out in claims. For Buffett, a company that could collect billions in float at a low cost was the ultimate investment. Geico's disciplined, low-risk approach meant it could generate a massive float without losing it all on expensive claims. Buffett invested, and he invested heavily, eventually having his company Berkshire Hathaway acquire the entire thing. Today, Geico is a marketing juggernaut. That initial narrow focus on government employees has exploded into a brand that is absolutely everywhere. The Geico Gecko, the Caveman Maxwell the Pig, the Hump Day Camel. These aren't just funny commercials. They are weapons of mass marketing. The goal is brand saturation. They want the name Geico to be so deeply embedded in your brain that when you think car insurance, the little green lizard is the first thing that pops into your head. Their famous slogan, 15 minutes could save you 15% or more on car insurance, is one of the most effective lines in advertising history. It's a direct, quantifiable promise of speed and savings. But what's the reality for the modern customer? Geico's strength is still its price, especially for drivers with a clean record, good credit, and a straightforward situation. Their online and mobile app tools are slick, user-friendly, and designed to get you a quote and a policy with minimal friction. They have stripped the process down to its bare essentials. However, this streamlined, low-cost model can have its downsides. When things go wrong and you need to file a complex claim, you're not calling a local agent who knows your name. You're entering a massive call center system. For some, the customer service experience can feel impersonal and frustrating, a common trade-off for rock-bottom prices. Geico is the undisputed king of direct-to-consumer insurance, a behemoth built on a simple idea, supercharged by Wall Street genius, and broadcast to the world through a relentless, unforgettable marketing machine. Now let's imagine the complete opposite. What if a company's entire identity wasn't built on bypassing the middleman, but on celebrating him? What if the core philosophy was that insurance is too important, too personal to be handled by an app or a 1-800 number? What if you needed to be in good hands? That brings us to our number 3 contender, Allstate. And its origin story is just as dramatic and insightful as the others. In the 1930s, a Sears executive was driving with his neighbor when their car collided with another, sending the neighbor's child flying into the windshield. Thankfully, the child was okay, but the incident sparked an idea. The executive, Robert E. Wood, mused that with all these new cars Sears was selling tires for, they should also be selling insurance, a product people could buy through the mail just like from the Sears catalog. The name? They borrowed it from Sears' most popular brand of car tires at the time, the Allstate tire. From the very beginning, Allstate was positioned differently. While Geico was targeting a niche group of low-risk professionals, Allstate, backed by the retail power of Sears, was aiming for Main Street, USA. It was insurance for the masses. But their true genius, the thing that cemented their identity for generations, was the embrace of the local agent model. Allstate didn't want to be a faceless company in some distant skyscraper. They wanted to be a physical presence in your town. They put a friendly, knowledgeable human being, the Allstate agent, in a local office right down the street. This created a powerful psychological advantage. The slogan, "You're in good hands with Allstate," wasn't just a catchy phrase. It was a promise embodied by a real person. Got into an accident? You don't call a faceless corporation. You call Dave, the guy you see at the grocery store, the person whose kid plays on the same soccer team as yours. This agent was supposed to be your trusted advisor, your advocate, the person who would guide you through the confusing and stressful process of a claim. For decades, this model was the gold standard. It built immense trust and loyalty. People felt protected, not just insured. Of course, this personal touch comes at a price. Maintaining thousands of local offices and paying commissions to a vast network of agents is expensive, and that cost is often passed on to the customer in the form of higher premiums. Allstate is frequently one of the more expensive options on the market. The modern challenge for Allstate has been to reconcile its traditional, agent-centric model with the digital age. They saw the writing on the wall with companies like Progressive and Geico eating into their market share with online-first approaches. Their answer? Play both sides. Allstate invested heavily in its own technology and even acquired Esurance, a completely online insurance provider, to compete directly for customers who prefer a digital experience. This creates a fascinating dynamic. You have the traditional Allstate brand, which still champions the local agent and the good hands promise, often appealing to customers who value service and a personal relationship over the absolute lowest price. Then you have their digital-first arms fighting for the price-sensitive online shopper. But the core criticism of Allstate often revolves around the claims process. Many consumer reports suggest that while the local agent experience can be excellent, the corporate claims department can be notoriously tough. The company that promises to be your caring neighbor can sometimes feel like a rigid, profit-driven corporation when it comes time to pay out. They've introduced programs like the Claim Satisfaction Guarantee to combat this perception, but the tension remains. Is the person in good hands the customer or the company's bottom line? Allstate represents the enduring power of the personal touch in an increasingly impersonal world, a legacy titan grappling with how to keep its promise in the 21st century. And now we pivot from the legacy of the personal agent to the architect of digital disruption. Coming in at number 3 on our list, with a formidable 14.1% of the U.S. auto insurance market, is a company whose very name is its mission statement, Progressive. If State Farm is the friendly neighbor and Allstate is the trusted pair of hands, Progressive is the brilliant, slightly obsessive data scientist in a lab coat who completely re-engineered the entire industry from the ground up. Their story isn't about tradition. It's about a relentless, almost fanatical pursuit of efficiency and a willingness to bet the farm on technology long before anyone else even saw it coming. To understand Progressive, you have to go back to its founding in 1937. While other insurers were chasing the safest, most predictable drivers, co-founders Joseph Lewis and Jack Green saw a massive, untapped market that everyone else was afraid of: the non-standard driver. These were the younger drivers, the drivers with a spotty record, the people the good hands didn't want to touch. Progressive built an entire business model on pricing risk more accurately than their competitors, serving a clientele that was grateful just to get coverage. This DNA of looking where others won't, of finding opportunity in complex data, is the bedrock of everything they would become. They were progressive long before the internet. They were the first to introduce drive-in claims centers, a radical idea that got customers back on the road faster. They were the first to allow customers to pay their premiums in installments, a financial innovation that made insurance accessible to millions of working-class Americans. They were constantly asking, how can we make this process faster, cheaper, and easier for the customer? But all of these innovations were just a prelude to the digital earthquake they were about to trigger. The year is 1997. The internet is a screeching dial-up novelty for most people. Amazon is just a bookstore. Google is still a year away from being founded. And in this primordial digital soup, Progressive does something that other insurance giants thought was insane. They started selling insurance policies directly to consumers online. Think about how revolutionary this was. The entire industry was built on a human-to-human network of agents. It was a relationship business. Progressive just bypassed the whole thing. They essentially said, we don't need the middleman. We don't need the expensive brick-and-mortar offices. We can connect directly with you, the customer, through this new thing called the World Wide Web. The legacy companies laughed. They thought insurance was too complex, too personal to be sold through a computer screen. They were wrong. Terribly wrong. Progressive poured the millions they saved on agent commissions directly into two things: technology and advertising. And that advertising gave birth to one of the most iconic and frankly bizarrely effective marketing mascots of all time, Flo. Flo is a stroke of marketing genius. In an industry defined by serious, deep-voiced men promising security, Progressive gave us a perky, slightly awkward, endlessly enthusiastic woman in a pristine white uniform. She doesn't sell you insurance. She helps you shop for it in the superstore, a brightly lit, sterile, fictional retail space where insurance is a product on a shelf, just like a box of cereal. The psychology is brilliant. Flo removes the fear and complexity from insurance. She's not an agent, she's a retail clerk. She's not negotiating, she's just scanning a barcode with her price gun. She made Progressive seem simple, transparent, and even fun. She gave a face to a faceless digital company, and that face was friendly, non-threatening, and utterly unforgettable. She became a cultural phenomenon, and in doing so she dragged the entire insurance industry, kicking and screaming, into the 21st century. But Flo was just the friendly face of a much deeper strategy. Behind the quirky commercials, Progressive was building a data-devouring machine. This led to their next game-changing innovation, the Name Your Price tool. Again, pure psychological brilliance. Instead of an insurer telling you what you have to pay, Progressive flips the script. You tell them what you want to pay, and the tool shows you what coverage options you can get for that price. It creates the illusion of control. The customer feels empowered, even though the underlying actuarial math is exactly the same. It's a masterclass in user interface design and consumer psychology. Then came the real bombshell, Snapshot, the little device you plug into your car that watches your every move. How fast you accelerate, how hard you brake, what time of day you drive. This was the dawn of telematics, or usage-based insurance on a mass scale. The pitch was simple and seductive. Prove to us you're a good driver, and we'll lower your rates. It was a direct challenge to the old model, which relied on blunt instruments like your age, your zip code, and your credit score. For the first time, your actual driving behavior could directly influence your premium. For safe drivers, it was a godsend, but it also opened a new Pandora's box of privacy concerns. Suddenly, your insurance company was your silent co-pilot, logging every trip, every hard stop, every late-night drive. It was a massive data grab, trading privacy for the possibility of a discount. And millions of people signed up, feeding the Progressive algorithm with trillions of data points, making its risk pricing models even more precise, and its competitive advantage even sharper. However, there is a dark side to this relentless efficiency. When your entire company culture is built around data, algorithms, and cost-cutting, what happens to the human element? For many customers, the answer is found in the claims process. The same cold, hard algorithm that gives you a competitive quote is also used to calculate your payout after an accident. And that algorithm's primary directive is to save the company money. This tension came to a horrifying head in 2012 in a case that became a public relations nightmare. A Progressive policyholder named Caitlin Fisher was tragically killed by an underinsured driver in Baltimore. Progressive paid out her policy to her family. But then, the Fisher family decided to sue the other driver to hold him accountable. What happened next was shocking. Progressive's lawyers showed up in court to defend the man who killed their own customer. Why? Because if the other driver was found not liable, Progressive wouldn't have to pay out on the underinsured motorist portion of Caitlin Fisher's policy. To save money, they found themselves on the side of the person responsible for their client's death. The story, detailed by Caitlin's brother Matt Fisher in a viral blog post, exposed the brutal logical endpoint of a system optimized for profit above all else. The company that presented itself with the friendly face of flow was, in this instance, a ruthless machine of calculated self-interest. Progressive is the ultimate double-edged sword. They are the great disruptor. Their technological innovations, their direct-to-consumer model, and their marketing genius forced the entire industry to become more competitive and more transparent on price. They are the reason you can get an insurance quote online in 5 minutes from a dozen different companies. But their story is also a cautionary tale about what can be lost in the pursuit of pure, data-driven efficiency. They change the game forever, but in doing so, they pose a fundamental question we all have to answer. When you have an accident, do you want to be helped by a person or processed by an algorithm? It's a question that cuts to the very heart of what we expect from insurance. And while Progressive bet everything on the algorithm, our next titan of the industry built its entire empire, its very identity, on the opposite answer. They built it on the promise of a person, a pair of hands. To be specific, a pair of good hands. This is the story of Allstate, a company born not in a boardroom of actuaries, but from the pages of the most dominant retail catalog in American history, the Sears, Roebuck & Company catalog. To understand how bizarre this is, you have to picture America in 1930. Sears was Amazon, Google, and Walmart all rolled into one. If you lived in rural America, that thick catalog delivered to your doorstep wasn't just a book of products. It was a window to the modern world. You could buy a house, a guitar, a new suit, a washing machine, all from your kitchen table. The one thing you couldn't easily buy? Car insurance. The idea came from a man named Carl L. Odell, an insurance broker, who pitched it to the chairman of Sears, General Robert E. Wood. The logic was deceptively simple. Sears had a massive, loyal customer base who trusted them implicitly. They had the most sophisticated direct mail operation on the planet. Why couldn't they sell insurance the same way they sold lawnmowers? Directly to the consumer through the mail, cutting out the middleman and passing the savings on. It was the original direct-to-consumer model, decades before Geico even existed. The name Allstate wasn't the result of a fancy branding agency. It was the name of a popular car tire sold in the Sears catalog. They just slapped the name on this new insurance venture and, in 1931, started stuffing applications into the catalog and mailing them out. It was a radical, almost absurd idea. Selling an intangible promise of financial protection, alongside tangible goods like hammers and socks. But it worked, because it was built on the unshakable foundation of Sears' reputation for trust. For years, Allstate was the mail-order insurer. But as the post-war boom filled America's new suburbs with cars, the company made a pivot that would define its future. They realized that while people would buy a tire from a catalog, a major financial decision like insurance often required a conversation. It required a human touch. So they started opening sales locations inside Sears department stores. You could go buy a new set of wrenches and, on your way out, sit down with a real person and secure a policy for your new Ford Fairlane. It was in this era of personal connection that the company's legendary slogan was born. The story goes that in 1950, an Allstate executive named Davis W. Ellis was attending a meeting when his young daughter came down with a bad case of hepatitis. He rushed home to be with her. As he sat by her bedside, she reached out, and he held her in his arms. She eventually fell asleep, and his wife turned to him and said, "You know, she was in really bad shape, but now she's in good hands." A light bulb didn't just go on. It exploded. That phrase, "you're in good hands," was everything. It wasn't about price. It wasn't about speed. It was about security, comfort, and the profound human need for reassurance in a moment of crisis. It became the soul of the company, and the physical embodiment of those good hands, the Allstate agent. This is Allstate's great strategic divergence from its competitors. While Geico and later Progressive were building systems to remove the human agent, Allstate was doubling down, building a nationwide network of them. The Allstate agent wasn't just a salesperson. They were positioned as a pillar of the local community. A small business owner you'd see at the grocery store, whose kids went to the same school as yours. When you had a claim, you weren't calling a 1-800 number to speak with a stranger in a massive call center. You were calling Dave or Mary, the person who sold you the policy, who knew your name and your family. This model created incredible loyalty. It transformed insurance from a cold, transactional commodity into a personal relationship. The trade-off, of course, was cost. Maintaining thousands of physical offices and paying commissions to thousands of agents is expensive. Allstate was rarely the cheapest option. Their value proposition wasn't price. It was peace of mind. They were selling the idea that when things go wrong, a familiar face is worth a few extra dollars a month. For decades, this model was a fortress, seemingly impenetrable to the low-cost, direct-to-consumer upstarts. But by the early 2000s, the world was changing. The internet was rewriting the rules of commerce, and companies like Geico and Progressive were using it to carpet bomb the airwaves with messages about saving money. The good hands started to look a little expensive. Allstate's brand, once a symbol of comforting security, was beginning to feel a bit old-fashioned, maybe even complacent. They needed to remind people why they needed good hands in the first place. They needed to make risk feel real again, and they did it by unleashing chaos incarnate. In 2010, a man in a sharp black suit, with a weathered face and a glint in his eye, walked onto our screens and introduced himself. "I'm a blind spot. I'm a distracted teen driver. I'm a flash flood." He was Mayhem. The Mayhem campaign, starring actor Dean Winters, was a stroke of marketing genius that is now taught in business schools. It was a complete inversion of typical insurance advertising. It wasn't funny like the Geico Gecko. It wasn't quirky like Progressive's Flow. It was dark. It was edgy. It was a little bit scary. Mayhem didn't sell you insurance. He sold you the problem. He was the physical personification of every random, unpredictable disaster that could wreck your car and your life. He showed you, in visceral, often hilarious detail, exactly what could go wrong. And after causing the crash, he'd lie there, battered and broken, and calmly explain that your cut-rate insurance policy might not cover this. The message was brutally effective. Saving a few bucks is great until you have to deal with me. Mayhem single-handedly made Allstate relevant to a new generation. It was a campaign that acknowledged the intelligence of the viewer. It said, "We know you're being bombarded with ads about saving 15%, but you're smart enough to know that the cheapest option isn't always the best one." It was a direct assault on the commoditization of the industry. It was Allstate screaming from the rooftops that protection matters more than price. The campaign was a massive success, reaffirming the brand's core identity while giving it a modern, clever edge. Yet, even with Mayhem as their champion, Allstate faces a fundamental dilemma in the 21st century. The very agent-centric model that built their empire is now their greatest challenge. Today's customers, raised on the instant gratification of the internet, expect to be able to get a quote, file a claim, and manage their policy with a few taps on a smartphone at 2 in the morning. They don't necessarily want to schedule a meeting with Dave or Mary. Allstate knows this. They've invested billions in technology, creating a sophisticated app and online tools. They have their own telematics program, DriveWise, to compete with Progressive Snapshot. But they are performing a delicate, high-stakes balancing act. How do you embrace the digital-first future without alienating the very agents who are the good hands your brand is built on? How do you streamline and automate without destroying the personal touch that justifies your premium price? Every move they make towards digital efficiency risks undermining their core identity. Yet, if they don't move fast enough, they risk being lapped by nimbler tech-first rivals. They are caught between the legacy of the Sears catalog and the dawn of artificial intelligence. Allstate's story forces us to confront an uncomfortable truth about what we buy when we buy insurance. Are we simply buying a financial product where the lowest price wins? Or are we buying something more? Are we buying a promise, a relationship, a sense of security that can only be delivered by another human being? And perhaps the most important question of all, in our increasingly digital world, what is the price we are willing to pay for peace of mind? That price, it turns out, is a multi-billion-dollar question. And our number 3 largest auto insurer in America built its entire empire on a deceptively simple answer. They gambled that for millions of us, the price of peace of mind was efficiency. They bet that we would happily trade a handshake for a lower premium, a personal agent for a slick mobile app. They bet that in 15 minutes they could not only save you money, but completely change your relationship with insurance. They are the government employees' insurance company. You know them as Geico. And the story of how Geico conquered the American mind has less to do with insurance than it does with 2 radical ideas. The first came from a man named Leo Goodwin Sr. in 1936. While the rest of the industry was chasing every driver they could find, Goodwin had a revelation. He realized that not all drivers are created equal. Some are simply less risky than others. So, he decided to target the safest, most stable group of drivers he could think of: U.S. government employees and top-tier military officers. The logic was brilliant in its simplicity. Safer drivers mean fewer claims. Fewer claims mean lower costs. And lower costs mean you can offer jaw-droppingly low premiums that your competitors, who have to insure everyone, simply can't match. But Goodwin's second idea was even more revolutionary. He asked a question that must have sounded insane to every other insurance executive in the 1930s. What if we get rid of the agents? At the time, insurance was sold exclusively through a massive, expensive network of local agents. It was a relationship business. But Goodwin saw them as middlemen, an entire layer of costs standing between his company and his customer. So he went direct. He sold his policies through the mail, directly to his carefully selected, low-risk clients. It was a lean, mean cost-cutting machine. For decades, Geico was a quiet, profitable, but relatively unknown company, the best-kept secret of federal workers. And it might have stayed that way, if not for a 20-year-old college student who stumbled upon it in 1951, a student named Warren Buffett. This is the moment Geico's story transforms from a clever business plan into a legend of American capitalism. While studying at Columbia under the legendary investor Benjamin Graham, Buffett discovered that his professor was the chairman of Geico. Intrigued, a young Buffett took a train to Washington, D.C. on a Saturday and banged on the door of Geico's headquarters until a janitor let him in. He eventually found the only executive working that day, a man named Lorimer Davidson. For the next 4 hours, Davidson explained the entire Geico business model to this one, intensely curious student. And in those 4 hours, Buffett saw the future. He saw what he would later call a moat, an almost insurmountable competitive advantage. Geico had two. First, their low-cost structure was built into the company's DNA. They could permanently undercut their rivals. Second, they had a built-in growth engine. Their customers were the most loyal, stable employees in the country. They rarely switched insurers, and they told their friends. It was a slow, steady, unstoppable force. Buffett went back and put more than half of his entire net worth into Geico stock. It was one of the first and most important investments of his life. He would later say he felt like he was onto something. That's the understatement of the century. Years later, after Berkshire Hathaway had become his investment empire, Buffett came back for the rest. In 1996, he bought the entire company, making Geico a wholly owned subsidiary. And then, he did something extraordinary. He took this quiet, efficient, direct mail insurance company, and he poured gasoline on the fire. He unleashed a marketing budget that the insurance world had never seen. He understood that Geico's model wasn't just for government employees anymore. In the age of the telephone and the internet, Everyone wanted to save money by cutting out the middleman. The target market was no longer just a niche group, it was all of America. But how do you sell a product that nobody likes talking about? A product people buy out of obligation, not desire? You don't sell the product. You sell an idea, a feeling, and you make it impossible to forget. Enter the Martin Agency, the advertising firm Geico hired. They faced a monumental challenge. Make insurance interesting. Their solution? A talking gecko with a charming British accent, a troop of offended, surprisingly articulate cavemen, a squealing pig named Maxwell, and a slogan so powerful it has become a permanent part of our culture. 15 minutes could save you 15% or more on car insurance. Let's break down why that was pure genius. It wasn't just catchy. It was a masterclass in behavioral psychology. First, it addresses the biggest pain point. Money. Save you 15% or more. It's a specific, tangible benefit. Second, it demolishes the barrier to entry time. 15 minutes. It tells you that this won't be a day-long ordeal. It's quick, it's easy. It respects your time. And third, the word could. That single word is legal and marketing brilliance. It's not a guarantee, it's a possibility, an invitation to find out. It creates curiosity and a call to action all at once. Through billions of dollars in advertising, Geico hammered this message into our collective consciousness. They used humor to disarm us, to make us associate their brand not with complicated legal documents, but with a friendly lizard. They turned a grudge purchase into a simple, almost fun transaction. They didn't just sell insurance policies. They sold the idea of being a smart, savvy consumer who doesn't overpay. And it worked on a scale that is difficult to comprehend. Geico exploded from a niche player into a national powerhouse, gobbling up market share year after year, all built on Leo Goodwin's original direct-to-consumer model, supercharged by Warren Buffett's capital and marketing vision. So what is the price of peace of mind in Geico's world? It's the cost of a phone call or a few clicks online. But there's a flip side. The very thing they eliminated to give you that low price, the human agent, is also the thing you lose. When you have a complex claim, when you need advice on your coverage, when you're standing on the side of a highway after a crash, you're not calling Bob, your local agent who knows your family. You're calling a 1-800 number and entering a digital queue. For millions, that's a trade-off they are more than willing to make. The data proves it. Geico's success is a testament to a modern consumer ethos that prioritizes price, speed, and digital convenience above all else. They perfected the art of transactional trust. But this raises a fascinating question. Is this the only path to the top? Is the relentless pursuit of efficiency and the elimination of the human touch the undisputed future of insurance? Geico's model is a devastatingly effective strategy, but it's not the only one. Because our number 4 company on this list looked at the exact same industry and came to the exact opposite conclusion. They bet their entire future not on a gecko but on a promise. A promise delivered by a human hand. A company that built its brand on the idea that in your worst moments, you won't be talking to a call center, but to a neighbor. A company that argues the ultimate peace of mind isn't found in a low price, but in the assurance that you are in good hands. You are, of course, in good hands with Allstate. Coming in at number 4 on our list, the Allstate Corporation is a titan of the American insurance landscape, a company whose very slogan has become a part of our national vocabulary. With a formidable market share of around 10.4%, Allstate wrote over $33 billion in private passenger auto premiums last year alone. But Allstate's story isn't just about big numbers. It's a fascinating tale of adaptation, of a company that was born from one of the most disruptive retailers in American history, only to build its empire on the most traditional, human-centric model imaginable. To understand Allstate, you have to go back to 1931, and you don't go to an insurance office. You go to the headquarters of Sears, Roebuck & Company. At the time, Sears wasn't just a store. It was the store, the Amazon of its day. Its massive mail-order catalog was a portal to the modern world for millions of Americans. You could buy a house, a guitar, a new suit, all from its pages. The chairman of Sears, General Robert E. Wood, had a brilliant idea. Sears was already selling tires and car batteries through its catalog. Why not sell the one thing every new car owner needed? Insurance? Think about how radical this was. In the 1930s, insurance was sold face-to-face by men in suits. It was a business built on handshakes and local reputation. Sears proposed selling it through the mail, directly to the consumer. No agent, no office, just a form in a catalog. They named the company Allstate, after one of their most popular tire brands. In a strange twist of fate, the company that would become the champion of the local agent actually started as the nation's first major direct-to-consumer auto insurer. It was the Geico of the Great Depression. For 2 decades this model worked. But as America boomed after World War II, and the suburbs sprawled, Allstate made a pivotal decision. They saw an opportunity not just in the mail but in person. They began opening sales locations inside Sears department stores. And from there, they evolved into the powerhouse agent-based network we know today. This is where the famous slogan, "You're in good hands with Allstate," was born in the 1950s. It wasn't just marketing fluff, it was a complete pivot in business philosophy. They went from being the impersonal, low-cost mail order option to the company promising a personal human connection. That local agent is the absolute core of the Allstate value proposition. Unlike a Geico or a Progressive, where you primarily interact with a website or a call center, Allstate's model is built around a network of over 12,000 exclusive agents across the country. These aren't just employees in a cubicle. They are independent business owners. They are stakeholders in their local communities. They sponsor the high school football team, they sit on the local chamber of commerce, and their name is on a sign on Main Street. The argument is that when you have a claim, when you're standing on the side of a highway after an accident stressed and confused, you're not calling an anonymous 1-800 number. You're calling Dave or Sarah or Mike, the person who sold you your policy, who knows your family, and whose livelihood depends on keeping you as a happy client. This model is designed to build trust and long-term relationships. For millions of Americans, that peace of mind is worth a premium. And make no mistake, you often do pay a premium for it. Maintaining thousands of physical offices and supporting a vast network of agents is expensive, and that overhead is baked into the price of a policy. This is the central tension of Allstate's existence in the 21st century. Can the high-touch, high-cost agent model survive and thrive in an era dominated by price comparison websites and digital-first competitors? Allstate isn't naive. They see the writing on the wall. They know that a new generation of consumers is perfectly comfortable buying and managing their insurance on a smartphone without ever speaking to a human. And their response has been a fascinating, multi-pronged strategy. First, they've invested heavily in technology. Their mobile app is slick and full-featured, allowing you to file claims with photos, call for roadside assistance, and access your policy documents. They were also an early pioneer in telematics with their DriveWise program, which rewards safe driving habits with discounts tracked through your phone. They are trying to give their customers the best of both worlds. The personal advice of a local agent, backed by the convenience of modern technology. But their most aggressive move was a direct strike at the heart of their competition. In 2011, Allstate bought Esurance for $1 billion. Esurance was a digital native, direct-to-consumer company, the very model Allstate had originally pioneered and then abandoned. With this acquisition, Allstate could now compete directly with Geico and Progressive on their own turf. For the price-sensitive customer who prefers to shop online, it was a brilliant, if defensive, move. It allowed the core Allstate brand to continue focusing on its relationship-based, premium service, while Esurance chased the clicks and the online quotes. Though they've since absorbed the Esurance brand into the main Allstate umbrella, the strategy remains to capture customers no matter how they prefer to shop. So, who is the Allstate customer today? It's often someone who is looking for more than just the rock-bottom price. They might be bundling multiple policies, home, auto, life, and want a single point of contact to manage that complex financial portfolio. They might be less comfortable with technology and prefer having an expert they can sit down with face-to-face. Or they might simply be someone who believes that when things go truly wrong, the value of a trusted advisor, a human advocate on their side, is immeasurable. The downside, beyond the potential for higher cost, is that your experience is entirely dependent on the quality of your specific agent. A great agent can be an incredible asset, saving you money and guiding you through difficult times. A mediocre or unresponsive agent, however, can leave you feeling like you're paying for a premium service that you're not actually receiving. Allstate stands as a testament to the enduring power of the human touch. They have successfully defended their number 4 spot against leaner, more aggressive competitors by betting that in an increasingly automated world, people still crave a personal connection, especially when it comes to protecting their most valuable assets. They have built an empire not on a quirky mascot or a catchy jingle, but on a simple, powerful promise that a neighbor, a real person, will be there to put their hands out and help you when you need it most. Their strategy has kept them firmly in the top tier, a legacy giant that has refused to be rendered obsolete. But as we climb higher up the ladder, we encounter the true behemoths of the industry. The top 3 companies don't just have a larger market share. They operate on a scale that is difficult to comprehend. And the company sitting at number 3 is a true paradox. A company that has managed to blend the agent-focused, personal touch of Allstate with the aggressive marketing and technological prowess of a direct writer, creating a hybrid monster that has reshaped the entire industry. It's a company that tells you to name your own price, and has convinced millions of Americans to do just that. And at number 3, with over 14% of the entire U.S. auto insurance market, is Progressive. The name itself is a mission statement. And that Name Your Price tool? It's one of the most brilliant marketing inventions of the 21st century. Think about it. It completely reframes the entire conversation. Instead of the insurance company telling you, "Here's our price, take it or leave it," they ask you, "What's your budget?" You, the customer, are immediately put in the driver's seat. No pun intended. You enter a number, and they show you a package that fits. It might mean higher deductibles or lower coverage limits, but the psychological effect is profound. It creates an illusion of control and partnership. It's not a negotiation, it's a collaboration. And it's a strategy born from a company that has spent nearly a century thinking differently. Progressive's story begins back in 1937. Founded by 2 lawyers, Joseph Lewis and Jack Green. They saw a gap in the market. At the time, auto insurance was largely for safe, low-risk drivers. If you were a bit younger, a bit riskier, maybe had a less-than-perfect record, most established companies wouldn't even talk to you. Lewis and Green saw this not as a liability, but as a massive, underserved opportunity. They started Progressive Mutual Insurance Company with a specific focus: to provide insurance to these riskier drivers. From its very first day, Progressive's DNA was coded with the idea of finding new ways to measure and price risk that others were too afraid to touch. This appetite for innovation wasn't just a founding principle. It became their primary weapon. In 1956, Peter Lewis, Joseph's son, took over. He was a visionary who believed the insurance industry was archaic and inefficient, and he set out to burn the old rulebook. While other companies made you wait for days or even weeks for an adjuster to come inspect your car after an accident, Peter had a revolutionary idea. In the 1970s, Progressive opened the industry's first drive-in claims service. The concept was simple but transformative. You get in an accident, you drive your damaged car directly to a Progressive center, and an adjuster is waiting for you. They assess the damage, write you a check, and you're on your way. It turned a week-long headache into a single afternoon errand. It was a masterclass in customer service that their competitors scrambled to copy for decades. But they were just getting warmed up. Progressive was also the first major insurer to introduce 24/7 customer service. Again, it seems obvious now, but back then it was unheard of. They understood that accidents don't just happen from 9 to 5, Monday through Friday. While their rivals slept, Progressive was taking calls, processing claims, and building a reputation for being there when you actually needed them. Then came the internet. And this is where Progressive truly left their competitors in the dust. In 1996, they launched the first major insurance company website. It was basic, but it was a beachhead in a new digital world. Just 1 year later, in 1997, you could buy a Progressive policy online. Think about that. While Geico was still mastering direct mail and State Farm agents were still using Rolodexes, Progressive was selling insurance through cyberspace. They saw the future before anyone else. But their single greatest digital innovation, the one that cemented their reputation as a tech-forward giant, came in that same year. They started displaying not just their own rate but the rates of their competitors right there on their website. This was unthinkable. It was corporate suicide, right? Why would you ever show a customer that they could get a better price somewhere else? But Peter Lewis understood human psychology. The move was pure genius. It projected an image of supreme confidence. It said, "We're so sure we offer the best value that we're not afraid to show you the other guys." It instantly built a mountain of trust. Even if Progressive wasn't the absolute cheapest option, the transparency made customers feel respected. It short-circuited the entire shopping process. Why spend hours calling 5 different companies when Progressive would do the work for you in 5 seconds? This digital prowess was eventually paired with one of the most iconic advertising campaigns in history. In 2008, a perky, energetic cashier in a white uniform and a blue headband named Flo first appeared on our screens. The concept was simple. Insurance is confusing, so let's set it in a bright, clean, simple superstore. Flo wasn't a celebrity spokesperson or a slick CEO. She was a helper. Enthusiastic, a little quirky, and endlessly helpful, she demystified insurance, putting everything in neat little boxes on a shelf. She became the friendly human face of a data-driven tech company, a perfect bridge between their complex algorithms and the average American family. While the Geico was charming, Flo was relatable. She felt like a person you could actually talk to, and she turned Progressive from a faceless corporation into a household name. Today, Progressive's obsession with data and risk has reached its ultimate expression. Snapshot. Introduced in 2011, it was one of the first widely available telematics programs in the U.S. The idea is to move beyond traditional risk factors like your age, your zip code, and your credit score. Snapshot uses a plug-in device or a mobile app to monitor your actual driving habits. How fast you accelerate, how hard you brake, what time of day you drive, how many miles you log. Yes, for some it feels a bit like Big Brother is riding shotgun. The privacy concerns are real, but the proposition is incredibly compelling. Your insurance rate should be based on how you drive, not how people like you drive. It's the ultimate form of personalization. Good, safe drivers are rewarded with significant discounts, putting the control, once again, right back in their hands. It's the Name Your Price tool evolved, where your price isn't just a budget you enter. It's a score you earn every single day. This relentless focus on technology and direct-to-consumer sales makes Progressive sound a lot like Geico. But here is their secret weapon, the key to their hybrid monster status. Unlike Geico, which largely shuns physical agents, Progressive has also built a massive network of over 30,000 independent agents across the country. This gives them a powerful two-pronged attack. They can capture the digitally savvy millennial who wants to buy a policy on their phone in 10 minutes. And they can also capture that person's parents, who prefer to sit down in a local office, look an agent in the eye, and have their hand held through the process. They can be a high-tech, low-cost direct writer, and a traditional high-touch agency-based insurer at the exact same time. They compete with Geico online and with State Farm on Main Street. This omni-channel strategy has allowed them to grow relentlessly, stealing market share from every direction. Progressive's journey from a niche insurer for risky drivers to the number 3 powerhouse in America is a testament to a culture that refuses to stand still. They are a data science company that just happens to sell insurance, but their ascent has put them on a collision course with the 2 most dominant, most entrenched, and most powerful companies in the entire industry. To climb any higher, Progressive has to do more than just innovate. They have to topple legends. They have to go to war with the titans who sit at the very top of the mountain. And the company at number 2 is a household name with a century of history, known for being in your hands for better or for worse. That phrase, of course, is "you're in good hands." And the company is Allstate. With a staggering 11.3% of the U.S. auto insurance market, Allstate is the undisputed silver medalist in this colossal industry. We're talking about a company that writes well over 100 million policies across all its brands, generating tens of billions of dollars in revenue every single year. Allstate isn't just a big company. It's an American institution, a brand woven so deeply into the fabric of the country that its slogan feels less like marketing and more like a cultural proverb. But the story of how those good hands came to dominate the industry is a fascinating tale of corporate synergy, brilliant marketing, and a ruthless pursuit of profit. It all started, believe it or not, with a bridge game and a catalog. In 1930, the president of Sears, Roebuck and Company, General Robert E. Wood, was playing cards with his neighbor, a man named Carl L. Odell. Odell, an insurance broker, pitched a wild idea. Why not sell auto insurance by mail? Sears was the Amazon of its day. The Sears catalog was the gateway to the American dream for millions of households, a place where you could buy anything from a wrench to a prefabricated house. Wood immediately saw the genius in it. Sears had a massive, loyal customer base and a distribution network that reached every corner of the country. They could sell insurance directly to consumers, cutting out the middleman and offering lower prices. It was a disruptive idea long before disruption became a Silicon Valley buzzword. The name Allstate was actually borrowed from a popular tire brand that Sears was already selling in its catalog. In 1931, the Allstate Insurance Company was born, a wholly owned subsidiary of Sears. Their first ad, a simple mail-in coupon in the Sears catalog, was a runaway success. In its first year alone, Allstate sold thousands of policies, proving that Americans were willing to buy something as complex as insurance through the mail, sight unseen, based purely on the trust they had in the Sears brand. For decades, Allstate and Sears were inextricably linked. You could buy a policy at a booth inside a Sears department store, right next to the Craftsman tools and Kenmore appliances. This was their superpower. While other insurers were building agent networks from scratch, Allstate had a built-in sales floor inside one of America's most beloved retailers. But the masterstroke, the single most important decision in the company's history, came in 1950. That's when the Good Hands slogan and the iconic logo of two hands cradling a car were created. This wasn't just a tagline, it was a promise. It transformed an intangible, complicated financial product into a feeling of safety, security, and personal care. It was marketing genius. The slogan was so powerful it became the central pillar of their identity, a foundation they would build upon for the next 70 years. And build they did. The company grew relentlessly, eventually becoming so large that it was spun off from Sears in 1993, in one of the largest IPOs of its time. Now independent, Allstate had to stand on its own 2 feet, and it did so by doubling down on what made it famous: branding and agents. They cultivated an image of the Allstate agent as a pillar of the community, a trusted advisor you could call when things went wrong. This image was cemented in the public consciousness by the commanding, reassuring voice of actor Dennis Haysbert. His calm, deep-timbered delivery made the Good Hands promise feel real, tangible, and utterly believable. For over a decade, he was the face and voice of Allstate, a symbol of stability and strength. But then Allstate did something incredibly risky. They introduced a second, chaotic character into their carefully crafted world of safety and security. They introduced Mayhem. Portrayed by actor Dean Winters, Mayhem was the personification of risk itself. He was the raccoon in your attic, the blind spot in your mirror, the rogue GPS that tells you to drive into a lake. The campaign was a smash hit. It was funny, edgy, and unforgettable. But more importantly, it was strategically brilliant. While Dennis Haysbert was selling the solution, the feeling of being protected by Allstate, Mayhem was selling the problem. He was a constant, hilarious reminder of why you need insurance in the first place. By creating a villain, Allstate made its Good Hands promise even more heroic. It was a 1-2 punch of marketing that no one else in the industry could match. Behind the brilliant advertising, however, lies a complex and controversial business strategy. This is where we get to the worst part of being in Allstate's hands. For years, the company has faced criticism for its aggressive approach to handling claims. The strategy was allegedly detailed in internal documents from consulting firm McKinsey & Company, which outlined a plan to increase profits by systematically offering lowball settlement offers to claimants and dragging out legal fights with those who refused to accept them. The idea was that many people, faced with mounting medical bills and legal fees, would eventually give up and take the smaller payout. Critics and consumer groups have labeled this the deny, delay, defend strategy. Allstate has consistently denied that it has a systematic policy of underpaying claims, stating that it handles each claim on its individual merits. Regardless of the official position, Allstate has developed a reputation among many trial lawyers and consumer advocates as one of the toughest insurance carriers to deal with. They are known for their formidable legal teams and their willingness to take a case to court rather than settle. From a purely business perspective, you can understand the logic. Every dollar not paid out in a claim is a dollar that contributes to the bottom line. It's a ruthless efficiency that has undeniably helped make Allstate a financial powerhouse. But for the individual customer who feels they are being treated unfairly after a traumatic accident, it can make the Good Hands slogan feel like a cruel irony. This dual identity, the caring protector on one hand, the ruthless litigator on the other, is central to understanding Allstate today. They are a company in transition, trying to balance their legacy agent-based model with the demands of the digital age. They saw the threat from online-first companies like Geico and Progressive, and instead of just trying to beat them, they decided to join them. In 2011, Allstate made a massive bet on the future by acquiring Esurance for $1 billion. Esurance was a pioneer in selling insurance online, and the acquisition gave Allstate an instant, powerful foothold in the direct-to-consumer market, allowing them to compete for customers who would never set foot in an agent's office. They are also investing heavily in technology and data through their subsidiary Arity, a telematics company that collects and analyzes vast amounts of driving data from smartphones and in-car devices. This allows them to offer usage-based insurance programs like DriveWise, which reward good drivers with lower premiums. It's a strategy to personalize insurance, making it more accurate and competitive, but it also positions Allstate at the forefront of the data revolution that is transforming the entire industry. So what we see at number 2 is a true titan, a company born from a mail-order catalog that grew into a marketing juggernaut. a brand that promises safety and security with one hand, while playing hardball with the other. They are a legacy company that is aggressively buying its way into the future, battling the old guard with its vast network of agents, while simultaneously fighting the digital disruptors on their own turf with brands like Insurance. They have the brand recognition, the financial firepower, and the strategic vision to challenge for the top spot. But they are still number 2. For all of Allstate's history, for all of its marketing genius and ruthless efficiency, it remains in the shadow of an even bigger giant. The company at the very top of the mountain is a different kind of beast altogether. It doesn't rely on edgy commercials or celebrity spokespeople. Its brand is built on something quieter, more pervasive, and arguably more powerful: ubiquity. The #1 auto insurer in America is so massive, so deeply embedded in communities across the nation, that for millions of people it's not just an insurance company. It's simply the insurance company. And its name is as familiar as the street you live on: State Farm. With a staggering market share that consistently hovers around 16 to 17%, State Farm isn't just leading the race. For much of its history, it has been the race. To understand how one company captured such an immense slice of the American auto insurance market, you have to go back to a simple yet revolutionary idea held by a retired Illinois farmer named George J. Metchelly. The year is 1922. The auto insurance industry is young, chaotic, and built around a single flawed assumption: that every driver carries the same amount of risk. Companies based in big cities like Chicago and New York were charging farmers and small-town residents the exact same high premiums as city drivers, who were navigating congested streets, dodging streetcars, and frankly getting into a lot more accidents. Metchelly, a farmer himself, saw the blatant unfairness in this. He knew his neighbors. They drove less on clearer roads, and they took meticulous care of their vehicles because their livelihood often depended on it. They were, by any logical measure, a safer bet. So, he did what great innovators do. He didn't just complain. He built a better alternative. Metchelly founded State Farm Mutual Automobile Insurance Company with a radical premise: charge people based on their actual risk. He offered lower premiums to farmers and rural drivers, a move that the established city-based insurers scoffed at. They saw it as naive, a surefire way to go bankrupt. What they failed to see was that Metchelly wasn't just undercutting them on price. He was building his company on a foundation of trust and common sense that resonated deeply with a massive underserved population. This wasn't just a pricing strategy. It was the birth of a new business model. But a good idea is useless without a way to deliver it. This is where State Farm's true genius, its enduring competitive advantage, was forged. Metchelly knew he couldn't build his company from a distant, impersonal office tower. Trust in rural America was built face-to-face over a handshake. So he created the exclusive agent model. He didn't hire salespeople. He recruited community leaders. He found respected members of local towns, often farmers, teachers, or small business owners themselves, and made them State Farm agents. This was a masterstroke. Suddenly, State Farm wasn't an anonymous corporation from some far-off city. It was Mr. Henderson down the street, the guy you saw at church whose kids went to school with your kids. Your insurance agent was your neighbor. When you had a claim, you weren't calling a faceless 1-800 number. You were walking into a small office on Main Street and talking to someone who knew your name. This model created a level of loyalty and customer retention that was unheard of. The agent wasn't just selling a policy. They were selling peace of mind, backed by a personal relationship. As America changed, so did State Farm. After World War II, the nation experienced the largest suburban boom in history. Families fled the cities for new homes with white picket fences and a car or two in every driveway. State Farm followed them. That agent model that worked so well in small towns was perfectly suited for the burgeoning suburbs. A State Farm office became as common a sight in a suburban strip mall as a grocery store or a barbershop. They grew with America, becoming an integral part of the new American dream. While Geico and Progressive were busy trying to cut out the middleman, State Farm was doubling down on them. They understood that for millions of people, insurance is complex and intimidating. People didn't just want a cheap price. They wanted guidance, a trusted advisor who could help them navigate life's biggest risks. The agent was the answer. They expanded their product lines aggressively, moving from just auto insurance to homeowners, life, and even banking services. The State Farm agent became a one-stop shop for a family's financial security, further embedding the company into the fabric of their customers' lives. This strategy of ubiquity and trust paid off on a scale that is difficult to comprehend. To put their 16% market share in perspective, think about this. For every 6 cars you see on the road, statistically, one of them is insured by State Farm. They write well over 40 million auto policies. The annual revenue from their auto premiums alone is greater than the entire gross domestic product of countries like Bolivia or Paraguay. They are, in every sense of the word, a Goliath. And of course there's the marketing. While other companies focused on mascots or humor, State Farm focused on cementing their core identity. The slogan, "Like a good neighbor, State Farm is there," is more than one of the most successful jingles in advertising history. It's a mission statement. It's a direct promise that perfectly encapsulates their agent-centric model. The simple 3-oval red logo is instantly recognizable, a symbol of stability and presence. They didn't need to shout about saving 15%, because their brand was built on something they believed was more powerful: being there when things go wrong. But the world that State Farm so masterfully conquered is changing. The very definition of a neighbor is evolving. Today, your neighbor might be someone you've never spoken to, and your most trusted advisor might be a YouTube creator or a Reddit forum. The direct-to-consumer model that State Farm once competed against has become the norm, supercharged by the internet and mobile technology. Customers, particularly younger generations, are increasingly comfortable, and often prefer, managing their finances through an app without ever speaking to a human being. This presents a profound existential challenge to State Farm's agent-based empire. The very thing that made them an untouchable giant for decades, their massive physical footprint and human sales force, is now an enormous source of overhead in an industry obsessed with cutting costs and streamlining through technology. Competitors like Progressive and Geico can pour the money saved on agent commissions directly into technology and lower prices, creating a pincer movement that puts immense pressure on the traditional model. State Farm, of course, is not standing still. They've invested billions in technology, developing a highly rated mobile app that allows customers to file claims, pay bills, and request roadside assistance. They've embraced telematics with their Drive Safe and Save program, using smartphone data to reward good drivers with discounts. A modern-day application of George Metreley's original principle of pricing based on actual risk. They are attempting a delicate, high-stakes balancing act: how to modernize and cater to a new generation of digital native customers without alienating their core base or dismantling the agent network that is the soul of their company. So while State Farm sits comfortably at the top of the mountain, the ground beneath them is shifting. Their story is a powerful testament to the idea that business is fundamentally about people and trust. They became number one not by being the cheapest, but by being the most present, the most familiar, the most human. They put a friendly face on an unfriendly industry. The question now is whether that friendly face can still compete when the customer is looking at a screen instead of looking you in the eye. The legacy of the farmer from Illinois is secure, but its future will be defined by its ability to answer that very question. And answering that question is exactly what our number one company has built its entire empire on. Because while State Farm was building an army of agents, one handshake at a time, another company was quietly building an algorithm. While one was focused on being your neighbor, the other was focused on being in your pocket, on your phone, and on your screen 24/7. It is the company that didn't just adapt to the digital age, it arguably created it for the insurance industry. With over 15% of the entire U.S. auto insurance market, and a name that has become synonymous with relentless innovation, the largest auto insurance company in the United States is Progressive. The rise of Progressive is one of the most fascinating stories in American business. It's a story of betting on the underdog, embracing technology before anyone else, and understanding the modern consumer better than any of its legacy competitors. And it starts, like many of its rivals, in the wake of the Great Depression. In 1937, two young lawyers, Joseph Lewis and Jack Green, saw a market that every other insurer was actively avoiding: high-risk drivers. These were the young drivers, the drivers with a spotty record, the people everyone else saw as a liability. Lewis and Green saw them as an opportunity. They believed that even higher-risk individuals deserved insurance, and that a business could be built by pricing that risk accurately. From its very first day, Progressive wasn't about a warm, fuzzy feeling. It was about data. It was a cold, calculated, and brilliant business proposition. For decades, they carved out this niche, growing steadily but quietly. The real explosion, the transformation from a niche player to a world eater, began in 1965 when Joseph Lewis's son, Peter, took the helm. Peter Lewis was not a traditional insurance man. He was a visionary, an art collector, a philanthropist, and a fierce, unapologetic disruptor. He looked at the slow, paper-shuffling insurance industry and saw a dinosaur waiting for a meteor, and he decided to build the meteor. Under his leadership, Progressive became obsessed with speed, convenience, and technology. Think about this. In 1994, when most of us were just hearing the screech of a dial-up modem for the first time, Progressive launched the first-ever insurance website. Before you could reliably order a pizza online, you could get an insurance quote from Progressive. They were the first major insurer to allow customers to buy policies online. They introduced 24/7 claims service, a radical concept at the time. They pioneered immediate response vehicles that could show up at an accident scene to help customers and begin the claims process on the spot. Every single move was designed to remove friction and put the customer in control. A direct assault on the old model of waiting for an agent's office to open. But technology and logistics were only half the battle. Progressive knew it had to win the war for attention. And in 2008, they unleashed their ultimate weapon. Her name was Flo, dressed in a crisp white apron, with a retro hairstyle and a perpetually upbeat attitude. Flo wasn't just a spokesperson. She was the personification of Progressive's entire strategy. She didn't work in a cozy, wood-paneled office. She worked in a bright, futuristic, all-white superstore. She wasn't your neighbor. She was a hyper-competent, slightly quirky retail clerk for insurance. The genius of Flo is that she solved the exact problem facing companies like State Farm: how to create a human connection through a screen. Instead of trying to replicate the agent experience online, Progressive created a new experience. Flo could explain complex coverages with a smile. She could magically produce a name-your-price tool. And she was always there on every channel, from TV ads to social media. She represented convenience, choice, and transparency, all wrapped in a disarmingly friendly package. She became one of the most recognizable brand mascots in American history, turning insurance from a boring necessity into a memorable and even entertaining product. Behind Flo's friendly smile, however, was Progressive's most radical and powerful innovation: data taken to its logical extreme. In 2011, they rolled out a program called Snapshot. It was a small device you plugged into your car that monitored your actual driving habits: how fast you accelerated, how hard you braked, what time of day you drove. This was the dawn of usage-based insurance on a mass scale. It was a seismic shift. For a century, insurance was priced based on proxies for risk: your age, your zip code, your credit score, your marital status. Progressive said, "Forget the proxies. Let's measure the real thing." This was a direct appeal to the modern consumer's sense of fairness and control. Good driver? Prove it and we'll lower your rates. It also gave Progressive an ocean of data that no competitor could match, allowing them to refine their risk models with terrifying precision. Of course, it also opened a Pandora's box of privacy concerns. How is that data used? Can it be used against you? What if you have to brake hard to avoid an accident? Are you penalized for being a safe driver in a dangerous situation? These are the complex questions at the heart of the new insurance landscape, a landscape Progressive largely created. From targeting risky drivers to pioneering online sales, from creating an iconic digital-first mascot to pricing insurance based on your every move behind the wheel, Progressive's story is one of relentless forward motion. They didn't just join the conversation about the future of insurance. They have consistently been the ones driving it. Their success is a testament to a simple, powerful idea. In the modern world, the company that offers the most control, the most convenience, and the most personalized price wins. And so, as we look back on this journey through the titans of American auto insurance, a clear picture emerges. It's a landscape carved by fundamentally different philosophies. We have Geico, the government employee-turned-direct-to-consumer behemoth, built on the promise of saving you money in 15 minutes. We have Allstate, the Good Hands Company, a spin-off from Sears that has mastered the balance between a vast agent network and a powerful direct brand. We have USAA, the unshakable fortress of customer loyalty, whose mission to serve the military and their families creates a bond that transcends price. We have State Farm, the quintessential American success story, the good neighbor whose empire was built on personal relationships, community trust, and an army of dedicated agents. And finally, we have Progressive, the tech-savvy disruptor that became the king by betting on data, convenience, and a woman named Flo. Each of these giants offers a different answer to the same fundamental question: what do you value most? Is it the lowest possible price? The unwavering loyalty of a member-focused community? The comfort of a personal relationship with a local agent? or the ultimate control and personalization offered by cutting-edge technology. The battle for your premium dollar has never been more intense. And as we barrel towards a future of self-driving cars, artificial intelligence, and a world where data is the new oil, the very definition of risk is changing. The giants we've discussed today will have to adapt or risk becoming relics. The one thing that is certain is that the competition between these 5 colossal companies, their different histories, strategies, and visions for the future, is what will shape the road ahead for every single driver in America. The power now more than ever is in your hands. The choice is yours.